The Income Tax Act 2025. Today is day 42, and I'll again be studying multiple sections of the Act. The first one is regarding the carry forward and set off of losses. It's section 119, subsection 2. It says it deals with the carry forward and set off of losses in case of succession other than inheritance, which means when a business or profession is succeeded by another person except by way of inheritance, then the other person is not eligible to set off the loss incurred by the earlier business. So therefore, only in case of inheritance he will be able to set off the loss of business. Other than that, any case of succession, they will not be able to carry forward and set off the losses incurred by the earlier business. Then the next section is section 119, subsection 3. This deals with the carry forward and set off of losses in case of certain companies. So let's first understand what used to happen and how this section was introduced to stop some practices. So this is an example of BB Private Limited. It has losses of rupees 100 crore, accumulated business losses of rupees 100 crore. The owners of this private limited are Mr. BB and Mrs. BB, having 90% and 10% shareholding. Now what they want to do with the business, they don't want to carry it on, but there might be some other business in the market who has a lot of profits and wishes to set off some of the profits with some losses, so that he does not have to pay a lot of income tax. Therefore there is a market for buying losses. So in that market, what would they do? They would sell off the business to that some other business person. Let's say Mr. A and Mrs. A. It is some other business. They have 90% and 10% holding, and they would purchase this business, and they will start holding this business as the 90% Mr. A and 10% Mrs. A. Now, what happens? They would expect to set off this loss of rupees 100 crore against their income from their main business in order to save some taxes. But this is clearly illegal. This is a method opted for tax evasion, and therefore it is not allowed. And that is why this section was included, to restrict such practices in the market. Let's just start what this section says. So in case of closely held companies, these are those companies which don't have a lot of people involved, mainly unlisted companies which don't have a public at large involved in them, and only a few people are connected with them. It can be private limited or public limited. Usually we'll say unlisted companies, whether private or public. So in case of such companies, what does this section say? It says that when you have incur a business loss in a certain tax year, and then you have to check at the end of such tax year who are your shareholders, who are the people holding shares in your company. Then in the tax year in which you wish to set off such a business loss, in that tax year you will again go to the end of the such tax year and see who are the people holding shares in the business. This section says you can only set off these losses in case these people, the people holding at least 51% of the shares in at the time of set off of losses, at the end of the year of set off of losses, are the same people who held shares at the time of the incurrence, at the time of incurring such losses. Meaning, here it's written in simple language, जिस साल में लॉस खाया उस साल के एंड पे जो शेयर होल्डर्स है, और जिस साल में सेट ऑफ किया उस साल के एंड पे जो शेयर होल्डर्स है वो 51% सेम होनी चाहिए. मतलब जो सेट ऑफ के साल में एंड पे शेयर्स होल्ड कर रहे हैं 51% एटलीस्ट सेम होनी चाहिए. एटलीस्ट 51% ऑफ द शेयर्स शुड बी हेल्ड बाय द सेम people who held the share at the time of incurring of losses. Only in this case, if this condition is fulfilled, then they will be able to set off such business losses. Otherwise, this loss will lapse forever. I mean, you cannot carry it forward for future and wait what happens in future. It will just lapse and you will not be able to utilize it in the future as well. This is an example of the same case. In tax year 24-25, a business is incurring loss of rupees 30 crore, and on the last day of such tax year, 31st March 2025, it has three owners, Kavita, Ravi, and Bhanu, who hold 40, 40, and 20% in the business. Then in tax year 25-26, they earn a PGBB income of 10 crore, and they want to set off such losses against this income. So what we'll do, we'll go to the end of this tax year, that is 31st March 2026, and check who are the people holding share in such company at this point. So we see that Kavita is holding 40%, Ravi is holding 30, and a new member has been added, Dikar, and he is holding 30% equity shares in the business. So we'll see the old members, Kavita and Ravi. These are the people who were holding at both times. If they are holding at least 51% currently, like they are holding 40 plus 30, which is 70%, so they are good. Means as long as they are holding more than 51% or 51% of the shares in the new business at the time of such set off of losses, means at the time of 31st March 2026, they will be able to set off such loss. Therefore, they are eligible to set off this 10 crore here in this tax year. And regarding the rest of 20 crores out of these 30 crores, this 20 crore will be carried forward to the next tax year. So in the next tax year, assume they have a PGBP income of 42 crores. But in the next tax year, Kavita and Ravi, the people who were present at the time of incurring losses, they hold only 35 and 10%, meaning a total of 45% of the equity shares in the business. Therefore, the business will not be eligible to carry forward or set off such loss. So this 20 crore rupees, which they wanted to carry forward and set off here, this will lapse. They will not be able to set it off in tax year 2026-27, and they will not be able to carry it forward either. So this is about this. And then there came a case about startups, because startups is a kind of business where you have to continuously raise money by diluting your equity. So an exception was made for startups and a different kind of rule was made for them. So let's assume this is a startup having two owners, Mr. Rajat and Mr. Visham, having 50% share, holding 50% equity shares in the startup each. And during tax year 25-26, they incur losses of rupees 10 crore. This is their equity holding position at the end of such tax year, means 31st March 2026. Then in the next tax year 26-27, they have some business income and they want to set off such losses against such business income. So we go to the date 31st March 2027 and see if the original people who were present at the time of incurring losses, if they are still holding shares in the company. So in this case, we see Rajat and Vishim, the original people who were at the time of incurring losses, they are still holding shares, but their share is only 20%. So normally we would have said that they are not eligible to set off losses, but this is the case of startups. In the startups, this condition of 51% does not apply. So the condition here is they should be present in the business only. That's the only condition. It doesn't matter if they hold 51% or only 1% in the business right now, they will be able to set off such losses. There are two conditions that they have to check. Firstly, they have to be owning some shares in the business. It does not mean they hold 51% or any other limit. They should simply just be just holding some shares in the business. Doesn't matter how much proportion. And then the loss, it should be incurred during the first 10 years since the incorporation of the startup, means it should not be earlier than that. Then for this same section, section 119 subsection 3, there are some cases where this section does not apply, means where there is a case of change in shareholding, but it is not considered as a change in shareholding, means we do not apply this section for the purpose of this. We do not apply these provisions, means checking 51% and all. We do not apply it in these cases. These are 5 cases. Firstly, the case of death. It's a natural occurrence. It can happen to any business, so it is pardoned. Then there is a case if we gift shares to any relative of the shareholder. In that case, also will not take it as a change in shareholding. And then there is a case where there is an Indian subsidiary who, due to amalgamation or demerger of for company, I will explain this with this example. Where is the example? Oh, the example. So this is the case of Indian sub. Like assume A Limited is an Indian subsidiary. Its holding company is X INC. X INC is holding 80% shares in A Limited. Let's assume this case. And then what happens? This X INC goes into amalgamation or demerger and becomes a new entity. Let's assume Y INC. Let's take this case of amalgamation. X INC amalgamates with some other business and forms Y INC. So technically now Y INC is the holding company of A Limited and it holds 80% shares of A Limited. So what happens to the business losses of A Limited before such amalgamation? They had some accumulated business losses, but at that time the shares were held by XINC. But now when they want to set it off, the shares are held by YINC. So in this case, it is allowed that when such case happens, A Limited will be allowed to set off business losses and carry it forward if they need to. There is only one condition that at least 51% of the shareholders of original foreign company continue in the new foreign company. Means the people who held at least 51% shares in XINC should be the shareholders in the new foreign company. Means they should be part of the should be holding shares in the YINC. At least 51% of those people who held shares in XINC. Then there are a few more cases like this resolution plan approved under Indian Bankruptcy Code 2016 or due to a resolution plan approved by NCLT. These are cases where you don't really have an option. It's a process initiated by government. So in this case also we do not consider it as a change in shareholding and we allow them to set up business losses. And this is the last case where there is an erstwhile public company and there is a strategic disinvestment of such public company. After this, the ultimate holding company continues to hold at least 51% of voting power, either directly or indirectly. Then they will be allowed to set off the losses of such public sector company. An example was like Air India. Air India was a public sector company and then it was transferred to one of the group companies of Tata Limited. The example must be here somewhere. Air India and Teles Private Limited. In that case, if Private Limited continues to hold 51% of the voting power of Air India of the business, which was Air India Limited, they will be allowed to set off the losses of such business. And there is this case when the condition is not complied with, means they don't continue to hold 51% voting power, then the provision of section 1193 shall apply. Then we'll start checking those conditions about holding shares at all. We will start checking that again. Now moving on to the completely different topic in this chapter, which is the aggregation of income. Aggregation of income is covered in section 101. It means that when we calculate total income of an SSC, we have to add deemed income and the share of profit from AOPBY when we calculate the income of AOPBY as per slab rates. Otherwise, it was exempt as I had studied earlier. So we have to add these two incomes while calculating total income of an SSC. So what is deemed income? That is dealt with in this chapter from section 102 to section 106. Starting with section 102, it deals with unexplained credits. So when any sum is found credited in the books of the SEC, means some amount has been credited into his books, and the SEC either offers no explanation about the nature or source, or he offers an explanation but it is not found satisfactory in the opinion of the AO. Then in such case the AO will treat such such amount which was credited in the books of SSE as his income, as his kind of undisclosed income. But then what happens when people get caught in this situation? They start saying that it was a loan or borrowing from some person. Then what the AO will do? He will approach such people who were named by the SSE, and he will ask for them. He will ask explanation from them regarding the nature and source of such money. And if they don't provide any explanation, or the explanation those people provide is not satisfactory, then the AO will deem the explanation of the SSE as not satisfactory and will add this amount credited as his income. We don't need to worry about those people who had been represented as paid loan to the SSC, because they are not in this assessment. They will not be taxed. Further, in the same section regarding unexplained credits, there is a case of closely held companies. It says, in case of closely held, let's first understand what people used to do in case of closely held companies. They used to, like, if some person has rupees 10 crore as black money, what he would do, he would distribute it among many people and ask them to invest it in his business in the form of application money or share capital or share premium or whatever name. And in that way they will try to convert such black money into white money. So this section covers such cases of closely held companies, and says that where there is a sum credited as application money, share money, or share premium in the accounts of such company, then the AO will go to the people who have been recorded in the books of the company as they have paid such application money or share capital money, and he will ask them for the nature and source of such money. And if they either not provide any explanation or their explanation is not satisfactory, then in that case the AO will deem the explanation of SSC as not satisfactory and add such amount in the as the deemed income of such company, BBVPL. Further, there is a small point to be noted. These conditions would not apply if the person whose name the sum is recorded is a venture capital fund or venture capital company registered with SEBI. This is an exceptional case. We don't need to apply this section when the person who is named, like, we received share application money from venture capital fund, then this section will not be applicable because they usually do pay normally. Moving on to section 103, these are similar kind of sections, all of these, but they have different topics. Section 103 deals with unexplained investments. It says when in any tax year the SSE either has not recorded investments in the books of accounts, or the amount at which the SSE has recorded such investments in his books of accounts is lower than the actual amount of investment, then in that case the SSE will be given a chance to explain himself, and in case he does not provide any explanation, or his explanation is not satisfactory, such investment amount is taxed as deemed income of the SSE. Or in case the amount recorded is lower than the actual amount, then the difference amount, the excess amount, will be taxed as deemed income of the SSE for the tax year. Similarly is the case under section 104 of unexplained assets. It says when there is an asset in any tax year, an asset in the form of money or bullion or jewelry or virtual digital asset or any other valuable article, which is either not recorded in the books of accounts, or the amount spent on acquiring such asset exceeds the amount recorded. Means, like, he has a gold coin which is worth 1,50,000. He says he purchased it today, but he has recorded it in his books of accounts at only rupees 50k. Now, why would anyone sell it for 50k when it's clearly sold everywhere for 1,50,000? So here's the SSC is trying to hide some of his money by doing such tricks. So in that case also, the difference, 1 lakh, is deemed as income of the SSC, but he'll be given a chance to explain himself in case he does not has no explanation, or his explanation is not satisfactory. This is the case where usually the explanation is not very satisfactory. People come up with all kind of reasons, like they found a gold bar randomly without their knowledge or anything else. They give some bullshit explanations basically, but that is not adequate for the purpose of this section, and that income will be deemed as income of the SSC for that tax year, because if they found such asset in their home, they need to disclose such asset. They cannot just keep it without disclosing it. Then there is section 105 about unexplained expenditure. It says that when an assessee incurs any expenditure and he offers no explanation about that, the source where he obtained that expenditure for, where he obtained the money using which he incurred such expenditure, then it is deemed as his income. This expenditure amount is like when Walter White purchased that Challenger car for his son. He did not have any explanation for the source of income. That is why Scalar made him return the car back to the dealership in order to protect him from this section only. But in America, they would have similar section there as well. So this is the case, and in India we can say like a person has normal books of accounts, and we discover that he's paying a rent of rupees 10 lakh every month, but this rent has not been recorded anywhere. So where does this money come from that he's paying this amount? And when he's asked, he does not provide any reasonable explanation. So that rupees 10 lakh which he is paying as rent every month will be added to his income. And then what some people might do, they say, okay, add it as income, and then I incur rental expenditure of 10 lakh as you have seen, so reduce it from my income. But that will not be allowed, because such unexplained expenditure has been added as income, and it is not logical to reduce the same as deduction, so it will not be allowed to be reduced as deduction. Then comes the case of promissory notes or hundi. It says when any amount is borrowed or repaid through a negotiable instrument or on a hundi, but it is borrowed or repaid through any other mode than account paycheck, means through cash or through bearer check or through any other mode, then such amount borrowed or such amount repaid, including the interest amount, will be deemed to be the income of the person. However, once it has been deemed to be the income of the person, he will not be able to liable again, like liable to pay tax on it again. Like when he borrowed such amount, it was deemed as income. Now, when he repays such amount, it will not be deemed as income once again, because he paid taxes on it already. An example of this hundi case is here. Mr. BB obtained a hundi from Mr. Vivek of rupees 50 lakh. It basically means that Vivek is saying that I promise to pay rupees 50 lakh to the bearer, kind of thing. So Mr. BB goes to Shweta and gets this hundi cashed out, kind of, and he obtains loan of rupees 40 lakh against this hundi. This loan which he obtained, and this loan he obtained through other than account pay check or specified banking mode. So this loan will of 40 lakh rupees will be deemed as income of Mr. BB, and when he repays that loan, it will not be assessed again as income, because he already will have paid the taxes on 40 lakh. Then there is section 107. This is the charge of tax for the same. It says that any income which has been assessed under section 102 to 106 will be taxable at tax rate of 30% and a surcharge of 25% and a cess of 4%. Means effectively we have to pay 39% taxes on such income which has been assessed from 102 to 106. These rates of taxes have been provided under section 195. And there is also this thing that we will not be allowed any kind of deduction or any kind of set off against such incomes. Now moving on to the last part of this section, which is section 120, which deals with the set off of losses consequent to search, requisition, or survey. It says that when there is a search under section 247, or there is a requisition under section 248, or a survey under section 253, and in as a result of such search, requisition, or survey, basically as a result of such raid, there is an income assessed in the hands of SSC, and against that, and that income is called as undisclosed income, and against such undisclosed income he will not be allowed any set off of losses, or he will not be able to claim deduction of unabsorbed depreciation against such undisclosed income. This is a simple section. Now, after this, there are some sections which are not really important, but still I have to go through them. Starting with section 116, which is carry forward and set off of losses in case of amalgamation, demerger, succession. It says when there is an amalgamation and the amalgamating company had some accumulated business losses, They can set the amalgamated company, which is the new company formed after amalgamation. It can set off such business losses. It can carry forward and set off such business losses. The period for such carry forward and set off would be fresh period of 8 years. Means they will get a new period of 8 years for such carry forward or set off, subject to note 3, which I'll read in a moment. And then in case of demerger, there is an accumulated business loss of demerged company. The resulting company will be able to carry forward and such of set off such business loss. Remember, this is the case of business loss for the remaining period of 8 years. Means we'll calculate the period from the date it was incurred by the demerged company. 8 years from the date it was incurred from the by the demerged company. Similarly, is the case of succession, where there is either conversion of firm proprietor into company or unlisted company into LLP. Then, in that case, they will also be able to set off and carry forward business losses for a fresh period of 8 years. Now, all these cases, the amalgamation case and these two succession case, they have a note 3. Note 3 says that if the amalgamation or succession took place after 1/4/2025, then the then the predecessor entity can carry forward and set off. Then the losses of predecessor entity can be carried forward and set off by the successor entity for remaining period of 8 years. Means this case of fresh period of 8 years will only be applicable if this took place before 1/4/2025. If it took place on or after 1/4/2025, the term will change to remaining period of 8 years. Now, continuing with this section 116, carry forward a set of losses in case of amalgamation and demerger. Now, we'll see the applicability of this section in various cases. This is applicable when there has been an amalgamation of an industrial undertaking or a ship or a hotel with another company. So, if there is an amalgamation of these industrial undertaking or a ship or hotel with another company, they will be eligible for carry forward and set off. The definition of industrial entity has been provided here. It means an undertaking which is engaged in either manufacturing, processing of goods, manufacturing software, generation, distribution of electricity, telecom services, mining, construction of ships, and all. So, this was the first case where this section 116 is applicable. The second case is the amalgamation of a banking company with a specified bank. Here also this section will be applicable. After this, the case is one or more public sector company or companies. When they amalgamate with one or more public sector company or companies, then also this section will be applicable. After this, there is a case where there is an erstwhile public sector company with one or more company or companies. If an erstwhile public sector company amalgamates with one or more company of companies, it will be applicable. But there is a little more condition to this point. It says that if the share purchase agreement entered into under this strategic disinvestment restricted the immediate amalgamation of the said PSC, means when such PSC has been kind of made private or there is a strategic disinvestment of public sector company, then at that time there was a share purchase agreement which restricted amalgamation of such entity. But it cannot restrict forever, so there will be a period up to which the restriction exists. So after that restriction ends, if the amalgamation is carried out within 5 years from the end of such restriction period, then it is eligible for section 116. Then the section 116 will be applicable to it. Now, here is a definition of strategic disinvestment. It means the sale of shareholding by central or state government in a public sector company, which results in the reduction in shareholding below 51%, which basically means privatization, like in the case of Air India Private Limited. Air India Limited, which was then purchased by Thales Private Limited, which is a company under Tata Group. Now, there are some conditions which needs to be satisfied by amalgamating company. Firstly, it should have been engaged in business for more than or equal to 3 years prior to the date of amalgamation, and then it should hold at least 75% of the book value of the fixed assets Amalgamating should hold at least 75% of the book value of fixed assets which are held 2 years prior to the date of amalgamation. Then there are a few conditions for three conditions for amalgamated company. First one is that it should continue the business of amalgamating company for 5 years. Then it should fulfill these conditions. The first one is it should reach at least 50% of the installed capacity within 4 years of amalgamation, and it should maintain that level until the end of 5 years from amalgamation. Means it has to fulfill these conditions. After fulfilling condition number 1 and 2, the amalgamated company also has to fulfill condition number 3, which says that it has to hold continuously for a minimum period of 5 years from the date of amalgamation at least 75% of the book value of fixed assets of amalgamating company acquired in the scheme. Means it has to keep holding such assets, 75% of the assets. If all these conditions are satisfied, then the accumulated loss and unabsorbed depreciation shall be deemed to be of the amalgamated company. Means it will kind of belong to the new business for a fresh period of 8 years. And if it happened after on or after 1 for 2025, then it will be remaining period of 8 years. Then there is this condition of deemed income. It says that if any of the above conditions are not complied with, then whatever set of loss or depreciation was made in any tax year in the hands of amalgamated company, that will be deemed as income of the amalgamated company, and it will be held chargeable to tax in the year in which such conditions were not complied with. And there is a small point regarding demerger. It says that when there has been a demerger of an undertaking, and all these business losses and all this stuff, it is directly related to the transferred undertaking, then we can fully carry it forward and set it off by the resulting company. But if it's not directly relatable, then we'll split it between demerged and resulting company in the proportion of their assets. Then there is this last clarification about, this is not section 116, this is just a clarification about stock and commodity market. It says it deals with the case where we have income from dealing in shares, transaction in shares. Now we have to decide what kind of a income we will show it as, whether it will go it under normal PGBP or speculative business income or capital gain income. So it says when the transaction in shares where delivery is affected, then in that case PGBP if the shares were held as stock in trade, and if they were held as capital asset, then it will be taxed under the head of capital gains. When the transactions in share happens without the delivery, like in intraday trading, then it is always a speculative business income. When the company is engaged in the business of buying or selling shares of other companies, then also it is speculative business income. When the transactions happen in derivatives like FNO and currency futures that recognize stock exchange, then it is deemed as normal business income.